So we've looked at the year that was and said relatively stable in terms of public opinion. And now we're looking forward. We're turning the page, and we've surveyed 1,000 people in the GTA who say that they're likely to buy a home, either very likely or somewhat likely, at least considering it. Of course, in order to get 1,000 of those people, we start with about 4,000, and we park the people who say, no, I'm not really interested in buying a home. Roughly the same field dates in November of last year, which would be comparable to the results of 2016, and that sample of likely home buyers is accurate to within plus or minus 3.5 percentage points. So here's one of our key metrics that we track for TREB. And this is how likely people are to buy a home. And you can see that what we call the top two box, if you combine those people who are very likely and somewhat likely, is 26%. But that's more heavily weighted to the 16% who say that they're at least somewhat likely than the 10% who are very likely. Those are the ones who, likely in the next 6 months will actually take the plunge. And we see some volatility in the tracking. On the upper line there, that dark blue line, that's the very and somewhat combined. And in November of 2015, it was 30%. In December of 16, 28%. In May, we went in field last spring, following some of the recent policy announcements, to gauge people's intentions. And would you look at that? It shot up to 35%. But most of that was just from people doing a little bit of introspection, perhaps saying, yeah, maybe I will buy a home. Maybe now's the right time, because all of these policy changes, could suggest that the market's going to bottom out. Home prices will go down. Maybe now's a good time to buy. But for those people who said they were very likely, that's all margin of error, right? 12, 10, 13, 10 points. So it was actually not really impacting those people with a strong intent. We just had more consideration that perhaps now was the best time. Now, of course, we've seen that the bottom hasn't fallen out of the market. And so if you were to remove that May 17 line and just look at the fall of 15, fall of 16, fall of 17, it's quite a steady curve. A slight downward trajectory, but quite steady. Now, for those people who say that they're not likely to purchase a home, we're asking them why. 29% say, well, they like their current home, where they live, they already own a home, they don't want another one. But there are some other factors here. And I wanted to pull out two in particular. 19% say, financial issues, I just don't have the money, or that homes are too expensive to buy now. And that's not surprising that in the 416, those figures are higher, at 26% saying something about costs or affordability versus only 15% in the 905. Similar on that other metric where price is a more significant concern for people in the 416 than it is in the 905. When we specifically ask them, did recent policy changes impact your decision not to purchase? So you're sitting on the sidelines, you're not going to get involved in the market, you're not going to buy. Why is that? Is it because of these changes? And the vast majority say no. No, the vast majority say no. Now, 85%, that's actually down 4 points. So fewer people are saying no, and more people are saying, yes, it had some impact. Now, only 1% say, if it were not for these policy changes, they would have purchased. So a very, very small proportion say, as a direct result of the policy, I'm not buying. For another 14%, and that's up 5 points from May, they said, it was a factor in my decision. Not the sole factor, but this has influenced me and said, well, made me decide that I'm going to stay on the sidelines and not purchase a home. Why are people buying a home? The vast majority, 84%, say to live in it. And that means that 16% say that they're buying it as an investment. Now, there have been fairly significant shifts compared to May. And remember, May was a bit of an anomaly, right? We went into field after the policy changes were announced, and there was a bit of a knee-jerk reaction, right? A lot of people saying, oh, maybe now's a good time to snap up a property at a really good price as an investment. Now that people have had a more time to think about it and to consider it, we see that we're probably in a more normalized environment period right now, where we've got 84% saying, yeah, I'm just going to buy a home to live in it, and 15% saying as an investment to rent to tenants, so not a vacant home, and only 1% say that they're going to purchase the property simply as an investment and not to rent it out. Which, of course, with the City of Toronto considering a vacant homes tax, you look at this and say, well, is that necessary given almost a negligible proportion of people are looking to buy a home to keep it vacant? So among those people who say that they're going to buy as an investment, we wanted to understand directly from them what impact, if the City of Toronto were to go ahead with a vacant homes tax, how would this impact your decision to buy? And for most people, they say, well, I'm still going to buy. I'm still going to buy. 46% say I'll have tenants. 38% say no impact. But for 14% of those people who were looking at buying an investment property, they say, if this comes in, I'm not going to buy. But 14% is a relatively small proportion, especially when it's 14% of the 16% who were going to buy as an investment property. What's that? 1%, right? Essentially, very, very few people. But it could still have an impact on a small segment of the market that's looking solely for investment purposes. So what other impacts has the recent policy changes had? And I think this is an interesting one because it's one where we don't ask a question, we just measure and say, well, what has changed in the marketplace? And I think policy is one of them. Historically, if we look at all the homes that were sold in a period and looked at what proportion of those homes were bought by first-time home buyers, you can see historically it was close to 50%. In June of 2015, 47% of all homes bought, first-time home buyers, and you as realtors would know that. Probably if you think, every other or so client, maybe a first-time home buyer. It was 49% in November 2015, 53% in December 2016, so lots of first-time home buyer activity. Following the policy changes and new threshold requirements, in May of 2017, that dropped to 40%. And I'm thinking in my head, okay, this is interesting. Is this a blip or is this a new reality? Where first-time home buyers are having a little bit harder time getting in the market because of these new rules. And it's been reaffirmed again in this wave. So it wasn't a blip. It's a new reality where fewer of the transactions involve first-time home buyers, likely because they aren't able to qualify or afford the home that they maybe would have even just a couple of years ago. Where are people intending to move? So on the left-hand side, we've got people who currently live in the 416 in Toronto proper, where are they likely to buy their home? Well, 8 in 10 say they're going to stay in the City of Toronto. That makes sense. We've got 19%, 2 in 10, who say that I'm going to move out into the burbs, into the 905, and 3% of those people who currently live in the 416 say, I'm out of the GTA entirely, and I suspect they're coming to Kitchener, where I live, because it's been a very busy market there. If we look at the folks in the 905 who currently live somewhere in the 905, 17% of them are saying, I'm looking to go into the city, into Toronto. So interesting, we've got 19% of Toronto residents moving to the burbs, 17% of burb residents coming downtown. It's essentially a wash, right? It's essentially a wash. 60% of those who currently live in the 905 are looking to stay in the 905, and fully 1/4 of those in the 905 looking to buy are looking to move outside of the GTA. In terms of purchasing intentions, new home versus resale homes, this tracks quite consistently with previous year's surveys. Not a lot of change there. 2 in 3 looking at resale, 1 in 3 looking at new homes. And if we ask what kind of home they're likely to purchase, it's interesting because there was, very stable results going back to 2015. If you just look at the very top bar, those are the aggregate results for purchasing a detached home. 52% in June of 2015, 54% in November. In 2016, 48%. And then, after the policy announcements, it goes down to 37%. And now it's back up to 47%. So here again, we're seeing this knee-jerk reaction. So if detached homes went down, what went up? Condos. So people, remember those people who were speculating that they might buy an investment property, probably thinking that the bottom's going to fall out and now's a good time to pick up a house cheaply. You know, we see a little blip in May and then back up in November. Your thoughts on this, Jason?
Well, I think it's going to be really important because if you think about, and later we'll talk about the range for the average selling price, what we expect to see in 2018, and I think we'll be at the upper end of the range if this share holds up, and we start to see more. We do actually see I guess a resurgence in the interest in terms of detached homes. If we don't see as much as perhaps the survey indicates, then that obviously could have a compositional impact on price. But I'll talk about that more in a bit.
So if we look at the estimated purchase price of a home, this really underscores that the May data was, again, a blip, a knee-jerk reaction, speculation that because of the policy, home prices are going to fall, and that both, in fact, in the 416 and the 905, people who said that they were looking at buying a home were looking at buying at a lower rate, at a lower price than the growth would suggest. If you remove that May 2017 data point, you can see that our new November data point is virtually where it was last year. And Jason will talk about price growth forecasts, and he already showed that there was some moderation at the end of the year. So this looks like it lines up really well with what Jason is going to be talking about later. May was a blip. We had a lot of excited people thinking that the market was perhaps going to tank. It hasn't happened, and now expectations are largely in line with where they were before. In terms of the down payment, very consistent, again, somewhere between that 20 and 30%, with the average actually rising. Just a couple years ago, it was about 28%, and now in 2017, we're looking at an average down payment of 31%. So despite the growth in home prices, the proportion of down payment is increasing. And among first-time home buyers, it's relatively stable as well. It was 25% a couple years ago, down to 24%, now up to 27%. So even though home prices are rising, and we are getting more concerned about the affordability for first-time home buyers, especially the slide that shows that activity is down among those people, overall, those that are buying still have a healthy down payment, even for first-time home buyers. Where are people getting their down payment? Well, 32% of the down payment is savings outside of an RSP. It's 13%, and 29% of that down payment is equity from a current home on average. For first-time home buyers, they're getting a larger share of it from savings, either inside an RSP or outside an RSP, essentially accounting for about half of it. 16% of that down payment is a gift. So perhaps the bank of mom and dad helping out, or maybe it's an inheritance or something else. 9% of that's equity from a current home. They may have inherited a home and now they're actually buying a home for their first time. In terms of where people are being approved, we're seeing a decline in the proportion of people who have been pre-approved at that 2 to 3 percentage points, and an increase in the proportion of people who are being pre-approved between 3 and 4 points. This makes a lot of sense given the general direction of interest rates. On the affordability of their mortgage, if there were a 2-point increase in interest rates, again, 80% of people say, yeah, I got this. I'm pretty confident that I can still manage my mortgage payments, even if rates were to go up by 2 percentage points. Conversely, 4% say not at all confident. So most people, I think, are sound in their household economics and their finances, saying, yeah, I got this covered. I can weather an increase in interest rates if that's what's coming. And in terms of the people who have qualified for a mortgage, we said, if those rates were 2 points higher, do you think you'd still qualify? And the vast majority at 74% say, yes, I would, but you've still got 1 in 4 saying, I'm not sure that I would have qualified. And among first-time home buyers, it rises to 29% who say, yeah, I wouldn't qualify at that higher threshold. So we see that the policy is having some impact, a larger impact on first-time home buyers, of course, who don't have really any equity to help them out with that purchase. Preferences for the mortgage type are very steady, again, despite interest rates going up. Most say that among those who are pre-approved, are looking at fixed-rate mortgages as opposed to variable-rate mortgages. Doesn't really change based on 416 or the 905. But when we ask people directly, okay, how have these policy changes impacted your thinking? Go all the way down to the bottom of the list and you see none of the above, okay? And it's only 24%. And that's actually down from 31%. So more people are saying that recent policy changes, such as more stringent mortgage qualification requirements, have influenced their thinking. And where has it impacted them disproportionately? The price of the home that they intend to purchase at 42%. And that's up 9 points from where it was last year. So people are likely, in effect, looking at less expensive homes as a result. And that may feed into some of the data that Jason is going to show you. And all the realtors in the room can rest assured that they still have good job security, because 82% of those looking to buy a home say that they are going to use a realtor to help them with that purchase. And over the long term, we actually see a slight increase from 79% a couple of years ago up to 82% now. And among first-time home buyers, a similar modest increase. It was 80% a couple of years ago. It's now 84%. Now I'll turn it over to Jason.
Thank you, sir. And I think you'll all agree that a lot of the issues that we've talked about through the results of the Ipsos intention survey, really do feed directly into where we expect to go in 2018. And I've broken it down really into what we expect to see in terms of transactions, and then how that will feed through into price growth. So first off, the Ontario Fair Housing Plan. So we talked about it from the perspective of what happened in 2017. But let's sort of think about, why, at least in my opinion, I think it's the effect of the Fair Housing Plan starts to wane as we move through the first half, of 2018. And Vancouver, or the Greater Vancouver area, is a good case study, because we essentially had the same policy decision a year earlier. So we're able to see that, number one, we were already starting to see a dip in sales in the Greater Vancouver area prior to the announcement of their foreign buyer tax, and some of that likely had to do with very strong price growth, similar to what we saw at the beginning of 2017. Now, added to that, though, is that we saw a further drop-off in terms of the number of transactions, but we also saw it bounce back in about a year's time, back to where we were at the announcement of the tax. So again, anytime you see sort of a large-scale, widely broadcast government policy that affects, what is the single largest purchase for most households, it makes sense that people take a bit of a step back. They sort of rethink about where they are in the marketplace, think about what their positioning is and what they want to do moving forward. But in the Vancouver case, certainly we saw people moving back into the marketplace, at least to the point of where they were sort of in the pre-tax period. So let's think about Toronto. So I showed you part of this slide earlier, but if you look, we were starting to see sales dip a little bit, especially between sort of the March and April period anyway at the beginning of 2017. Still very high, but we were starting to see some of the impact of pricing anyway. But certainly after the announcement of the tax, as we moved through May, we saw those sales drop off further to the point where we were running at about 6,000 as we moved through late spring and into the early summer, which was certainly low from an historic perspective. We can see that if you look at the preceding years. But what's sort of interesting is we did start to see a recovery, and I'd argue that through, say, October, or certainly through the end of the third quarter, we were starting to see an uptick in sales anyway, and that suggests to me that we were starting to see some people who had taken a step back move into the marketplace. We saw an even larger uptick in sales activity as we moved through the fourth quarter, and argue that some of that is a result of people starting to shake off the effects of the Fair Housing Plan. But number two, I'd also argue that it was also the impact of some people pulling their decision to purchase forward as a result of the new stress test coming into effect January 1st of this year. So the OSFI stress test and higher borrowing costs. I don't think any of you working in real estate would argue that higher borrowing costs or higher qualification standards can certainly stunt demand, at least to a certain degree. If we look at what the impact is in terms of qualification, if you're looking at monthly payments, you're looking at it for a detached home, that qualification number would be about $960 higher on a monthly basis for a detached home. That's not necessarily what you pay. Don't forget this is qualification, but that can have an impact. And across the board, right down through condominium apartments, there is a higher qualification amount that will be tested against your income from January 1st of this year and as we move forward through 2018. Bottom line too is the borrowing costs are certainly higher. So in line with a higher standard in terms of qualification, that qualification standard is also bumped up just by the fact that the borrowing costs are up on average. This is the 5-year Government of Canada bond. It gives us a good idea of what it costs lenders to raise money to turn around to lend out to your clients in the form of a mortgage. The notion here being that we will continue to see a gradual uptick in borrowing costs as we move through 2018. So obviously that can have an impact as well. Now on the plus side, though, while we will be up against the impact of higher borrowing costs and higher qualifications, we still have a lot going for us in the GTA that should continue to drive demand for housing in general and certainly ownership housing as well. I mean, we're staring at increased immigration targets, and historically the Greater Toronto Area has been Canada's single greatest beneficiary from a metropolitan area perspective of immigration, so certainly household growth should continue. Tight labor market conditions. We're seeing some of the tightest labor market conditions, low unemployment that we've seen in decades. And I think the rental market and conditions there are going to have an impact too. So there you go. If you look at the unemployment rate, the lowest it's been since the turn of the new millennium. And that means that, it's difficult for a lot of employers to bring on new workers. And when that's the case, just like the housing market, a tight housing market results in stronger uptick in prices. In a tight labor market, you see a stronger increase in wages and salaries, and that leads to consumer confidence. Rental market. Certainly when you think about people moving into the Greater Toronto Area, it's nice to have options. We have an expensive housing market in the GTA. Some of these people moving into our region might like to rent instead. But the issue is it's a tough option right now because the vacancy rate is low and it's getting lower. If you look at purpose-built apartments, you've gone from 1.4% vacancy rate in 2016 to 1.1% in the fall of 2017. Similarly, for investor-owned condominium apartments, you've gone from 1% in 2016 to below 1% in 2017. Whichever way you cut it, whatever you're looking at in terms of rental accommodation, that's a tough nut to crack right now. So it's not necessarily an option or a substitute for all households moving into the Greater Toronto Area. And I'd argue as we move forward, now that we're looking at sort of an increase in sort of ceilings for rent increase guidelines, that could provide a further issue. Because if I'm an investor looking at purchasing either a purpose-built property to rent out, or if I'm looking at buying a condominium apartment to rent out, and I have a ceiling in terms of how much I can raise my rents versus no ceiling on the amount my costs can go up, then I may take a second look at that in terms of an investor as well. So in terms of sales, I present a range here because I think we are sort of still within a pretty volatile period on the back of two policy decisions. One that likely will wane, as I said, as we move through 2018, but then up against obviously a stress test guideline that could present some issues. I think the bottom line is that sort of a midpoint in this range puts us right around where we were in 2017, but I think the tables are reversed a little bit, where I think we're going to see a slower start to the year, probably seeing annualized sales closer to where that yellow line is, and as we move through the year, we'll see an uptick in demand for two reasons. Number one, there'll be fewer people that are being impacted by the Fair Housing Plan, but number two, people will come to terms with the new stress test guidelines as well, and so they'll be able to perhaps look at other sources in terms of lending. They'll also consider other options in terms of what type of home they're going to buy and at what price point, and also what part of the GTA they may be looking at as well. So in terms of price growth, then the issues that are impacting the marketplace is the balance in the marketplace. So that impact between demand and supply, but then also looking at the fact that inventory is quite low on the other end of the spectrum, especially when you consider the condominium apartment market. But just before I sort of present what my thoughts are on sort of the range for price in 2018, I thought I'd put it back to Sean, because one of the things that we've added in the last couple of surveys is also looking at people's likelihood to list, and that's important when we're thinking about that relationship between demand and supply.
Mm-hmm. Yeah, thanks, Jason. So the first thing here is that you can see that more people are at least considering putting their home on the market. Back in May, it was 30% who were at least somewhat likely. Again, the somewhats are just thinking about it. It's the varies who have some intention. So 30% split between 12% very likely, 18% somewhat likely. And now in November, at the end of last year, more are considering, right? They're looking around, they're saying, oh, well, the bottom didn't drop out of the market. Now may actually be still a good time for me to maximize the value of my investment. So the proportion that are somewhat likely went from 18 to 27. That's a huge jump in the people thinking about it. But the very likelies have only gone from 12 to 14. A modest uptick within the margin of error of the poll. So very stable. But I think what the trend suggests is perhaps a general easing of supply, of inventory, a little bit more inventory coming on the market, or at a quicker pace than it maybe has in the past. Why are these people listing their home for sale? Well, I mean, most is some personal reason. They're looking to get a bigger home, or downsizing, or retired, or some life event has triggered that. But for 28%, there's a financial reason, and that's up from May, up from 22%. And most of that is being driven by people who say, now's a good time to take my profits and make money. So the bottom didn't fall out in May, so now now it may actually be a pretty good time to capitalize on that investment. And here's where the policy changes have had the biggest impact. So not on people necessarily staying on the sidelines, not on people necessarily buying a home, but on people's calculus as to whether or not now is a good time to sell, right? Because of what may happen with the market. So you've got only 38% of people saying, no, it's not impacting my decision to sell at all. And that is down significantly, meaning for more people, there's a greater impact. 1 in 5, 20% of people who are thinking about selling their home say, if not for these changes, I wouldn't even be considering it. Right? 1 in 5. That's a significant impact. And another 42% who say that it's a contributing factor. Maybe not the sole impact, but a contributing factor. So people are still trying to figure out, where we're headed, where there's a little bit of uncertainty in the market. People aren't quite sure where prices are headed. What's your plan once you sell that property? Well, intuitively, for the vast majority of people, it's to buy another property, 74%. Although that's down slightly, 4 points from May. 11% say that their plan is to rent a property in which to live. So they're going to take their profits and they're going to rent. We know that's a trend among boomers, and that's up 3 points. But I mean, when we look at Jason's slide a couple slides ago that says that the rental market is already tight, and we may be seeing some more activity in the rental market, some people choosing to leave home ownership and rent, I think that's probably only going to become more challenging.
Right, and just on that notion of supply and inventory, and I think it's important to point that you mentioned that there is the potential that we'll see a better supplied market in 2018, but it's important to note that right now we haven't seen a situation where supply is going through the roof. I mean, right now we're looking at months of inventory in the neighborhood of 2.5 months, and it actually trended a little bit lower as we saw an uptick in buying activity in the fourth quarter. And so, when we look at 2.5 to 3 months of inventory, it's not speaking to 30% price growth like we were seeing this time last year, but it's certainly not speaking to price declines either. It's really pointing to price growth moderately above the rate of inflation, say in that sort of 5-6% range historically. And I think the next slide kind of points that out. We're turning months of inventory on its head and just looking at sales to active listings relative to price growth. And I think we've overshot actually in the other direction to a certain degree on year-over-year price growth when you look at where we've kind of balanced out here at about a 40% sales to active listings ratio. That would suggest, decent price growth on a year-over-year basis. But I think how that's going to play out in 2018 is probably at the start of the year. We're not going to see as strong of growth, similar to the handoff from 2017. And don't forget, we're going to be comparing prices to what was a very strong spike in home prices through, say, the first 4 months of 2018. And so, in all likelihood, we'll be talking about prices down on a year-over-year basis during the first 4 to 5 months of the year. And then I think you're going to see that turn around and see an uptick in price growth to that sort of mid-single-digit range. And what will impact where we eventually end up within that overall range, I think, has a lot to do with composition. If we see, a share of detached home sales similar to what we saw in the spring, then that would see a bit of a lower level of overall average price. But if we do, in fact, see what your survey suggests, that detached buying intentions will pop back up to more historic norms, then I think that would feed through in a little bit stronger price growth and perhaps see prices slightly above what we saw in 2017. Certainly, market conditions as they stand right now, sales versus listings, certainly do support further price growth. So with that in mind, I want to call on Matthew Buchal to speak to the new home market and some segments of the commercial market as well. And I just want to point out that Sean's survey spoke to how important realtors are within the context of overall transactions from a resale market perspective. Well, they're important from the new home perspective as well. Altus's discussion on impacts in the economy found that it's tens of billions of dollars spin off from new home construction. And what we found is that looking forward, 62% of people looking to purchase a new home also are intending on using a realtor to help them in that transaction. So over to you, Matthew.